Something happened that nobody's talking about in the right way. Everyone's debating whether Operation Epic Fury was justified, whether Trump had the authority, whether killing Iran's supreme leader was strategic or reckless. But that's not what matters for your money. What matters is that oil futures just surged 5% in hours. Gold broke $5,300 per ounce, and your 401k is sitting in the crosshairs of a geopolitical event that could reshape global markets for years. I canceled everything and spent the last 48 hours analyzing energy reports, Federal Reserve projections, and market data since the strikes launched. What I found isn't about politics. It's about mechanics. The mechanics of how 20% of global oil supply flows through a choke point that Iran just closed. The mechanics of how inflation that was already running hot just got an accelerant poured on it. The mechanics of how the portfolio you built for retirement is about to get stress tested in ways most investors haven't seen since 1973. Here's what they're not telling you. This isn't like Venezuela in January. That was a surgical extraction. This is sustained combat operations against the world's fourth largest oil producer. And whether you're planning to retire next year or in 30 years, the next 90 days will determine where your money goes and how much it's worth when it gets there. I'm going to show you exactly what's breaking right now. The Strait of Hormuz choke point that controls your gas prices, the inflation spiral that central banks can't stop, and the portfolio rotation that started Friday before most people even knew strikes were coming. Let me show you 5 data points from the last 72 hours. None of them made primetime news, but when you connect them, the economic pattern is unmistakable. First, Saturday morning, February 28th, 0600 hours. Eastern, the United States and Israel launched Operation Epic Fury against Iran. Coordinated strikes on Tehran, multiple waves, targeting government buildings, military infrastructure. Israeli forces reportedly killed Supreme Leader Ayatollah Ali Khamenei. The Pentagon is calling this major combat operations, not targeted strikes, major combat operations. That's the terminology you use when you're planning to stay. Second, within 8 hours, oil-linked futures on decentralized exchanges surged 5%. Energy analysts at Rapidan Energy told CNBC that when markets open Sunday night, crude futures will likely jump an additional $5 to $7 per barrel. That puts Brent crude at $78 to $80. Some projections show $10 to $20 spikes if the Strait of Hormuz stays closed. On Friday, Brent was trading at $72.48. A $10 jump means gas at the pump goes up 30 to 50 cents per gallon within a week. Third, gold hit $52.99 per ounce Saturday, up from breaking $5,000 just days earlier. That's a 22% gain year-to-date in 2026. In India, domestic gold prices jumped 3,160 rupees in a single day. This isn't speculation. This is capital flight to safety happening in real time. Fourth, Iran retaliated Saturday by launching ballistic missiles at U.S. bases in Qatar, Kuwait, the UAE, and Bahrain. Multiple oil majors and trading houses suspended shipments through the Strait of Hormuz immediately. The EU naval mission instructed all vessels to halt passage. That strait handles 20 million barrels per day. 20% of global oil consumption. And it's effectively closed right now. I'm sure that's just a temporary logistics issue. Nothing to worry about. Fifth, Friday before the strikes, defense stocks were already moving. Lockheed Martin up 2.56%, Northrop Grumman up 2.4%, RTX up 1.2%. Volume on Lockheed hit 2.5 million shares, well above its 50-day average. Why? Because markets were pricing in the probability of action all week. Institutional investors with access to intelligence were positioning before you even knew what was happening. Now, I'm sure these are all just coincidences. The U.S. launches major combat operations. Oil futures surge. Gold surges. Iran closes the most important oil choke point on the planet. And defense contractors see their stocks rally before most people even read the news. Just another series of unfortunate coincidences involving the global economy and your retirement account. But when you add it all up, you end up with a lot of coincidences. This playbook isn't new. We've seen oil shocks triggered by Middle East conflicts 4 times in the last 50 years, and every time, the pattern is the same. Geopolitical event triggers oil spike triggers inflation triggers Federal Reserve response, markets reprice risk. First, 1973, the Yom Kippur War, and Arab oil embargo. Arab members of OPEC declared an oil embargo against the United States. Oil prices quadrupled from $3 per barrel to $12 in 6 months. Gas stations ran dry. The U.S. economy went into recession. Unemployment spiked. Inflation hit double digits. The stock market crashed 45% from its 1973 peak to its 1974 low. It took years to recover. Second, 1990, the Gulf War. Iraq invaded Kuwait. Oil prices doubled from $20 to $40 per barrel in 2 months. The U.S. entered a recession that lasted 8 months. The S&P 500 dropped nearly 20%. Markets didn't recover until the war ended quickly in early 1991. Third, 2003, the Iraq invasion. Oil prices spiked from $30 to $40 leading into the war. But markets adapted faster because global oil supply was more diversified and the Strategic Petroleum Reserve existed as a buffer. The S&P 500 rallied because the outcome was predictable. Fourth, June 2025, the Iran nuclear strikes. The US and Israel struck Iran's nuclear facilities. Oil prices jumped but pulled back within days because Iran didn't close the Strait of Hormuz. Retaliation was muted. Markets normalized quickly. Same playbook, same players, same outcome: oil shock, inflation pressure, market repricing. But here's what's different now. In 1973, US debt to GDP was 35%. In 1990, it was 55%. Today, in 2026, it's 124%. The US has less fiscal room to absorb an oil shock. The Federal Reserve has less monetary room because inflation is already elevated. And this looks a lot more like 1973 or 1990 than it does like 2003 or June 2025. Same playbook, same players, but a much more fragile system. Let me walk you through the three mechanisms that are breaking right now. Mechanism 1, the Strait of Hormuz Chokepoint. Here's what you need to understand. Iran produces 3.3 million barrels of oil per day. Despite sanctions, they still export 1.9 million barrels per day according to the International Energy Agency. That's significant. But that's not the real problem. The real problem is geography. Iran sits on the northern coast of the Strait of Hormuz. That strait is 30 miles wide at its narrowest point, and 20 million barrels of oil pass through it every single day. That's crude from Saudi Arabia, the UAE, Kuwait, Iraq, and Qatar. 20% of total global oil consumption flows through that choke point. And Iran controls it. They've threatened to close it multiple times over the years. And now they're actually doing it. As of Saturday, major oil trading companies suspended shipments. That means tankers aren't moving. Crude isn't flowing. And the global oil market is going to reprice risk when futures trading opens Sunday night. Energy analysts at Clearview Energy Partners told CNBC that the Strategic Petroleum Reserve currently has 415 million barrels. The Trump administration could tap it if prices spike. But here's the problem. Duration matters. If the strait stays closed for weeks, not days, the SPR can't cover global demand gaps. And prices don't just go up, they spike. Now let me show you how that impacts you. When oil prices rise, it's not just about filling your gas tank. It's about the cost of everything. Groceries get shipped by trucks. Those trucks run on diesel. Diesel prices track crude oil. When crude goes up, diesel goes up. When diesel goes up, transportation costs go up. When transportation costs go up, grocery stores pass that cost to you. The same avocados you bought last week cost more this week. Not because avocados got scarcer, because the cost to move them from the farm to the warehouse to the store increased. Airlines face the same problem. Jet fuel is refined from crude oil. Higher crude means higher jet fuel costs. Airlines either absorb the hit to margins, which tanks their stock price, or they raise ticket prices, which reduces demand. Either way, airline stocks get hammered. And if you own any travel or consumer discretionary stocks in your portfolio, you're about to feel it. Now here's where it gets worse. Inflation was already running hot. Earlier this week, the Federal Reserve got new producer inflation data showing prices for businesses are higher than expected. Producer inflation means the cost of raw materials that businesses use to make products. If businesses pay more for raw materials, they pass that cost to consumers. That's how inflation works. The Fed has been trying to manage this by keeping interest rates elevated. The idea is higher rates slow down borrowing, which slows down spending, which cools demand, which brings prices down. But now you throw a $20 oil shock into the mix. Suddenly, the Fed's inflation problem just got exponentially harder. Because they can't control the Strait of Hormuz, they can't force Iran to reopen shipping lanes, and they can't print their way out of a supply shock. Mechanism 2, the inflation spiral nobody can stop. Let's connect this to what's happening with interest rates. President Trump has been vocal about wanting lower interest rates. He just nominated Kevin Warsh to replace the current Fed chairman. Why? Because Trump wants rate cuts. Lower rates make mortgages cheaper. Lower rates make car loans cheaper. Lower rates stimulate the economy. But here's the constraint. The Federal Reserve can only cut rates if inflation is under control. If inflation is running at 4 or 5% and the Fed cuts rates, that makes inflation worse. How? Because lower rates mean cheaper borrowing. Cheaper borrowing means more people buy houses. More people buying houses means bidding wars. Bidding wars mean home prices go up. That's inflation. So the Fed has been stuck. Inflation hasn't come down enough to justify rate cuts, and now oil prices are spiking. If Brent crude hits $80 and stays there, consumer prices are going to rise. The Yale Budget Lab already estimated that even without the Iran conflict, tariffs and other factors were pushing consumer price inflation up by 0.6%. Now add a sustained oil shock. You're looking at 1 to 2% additional inflation pressure. That puts the Fed in an impossible position. Cut rates to help Trump politically and risk inflation spiraling higher, or keep rates elevated to fight inflation and risk a recession. Neither option is good, and your 401k is sitting in the middle of this tug of war. Here's the math on your retirement account. If you have money in a 401k, it's invested in the stock market. Stock prices go up when there are more buyers than sellers. But when inflation is high and interest rates stay elevated, two things happen. First, corporate profit margins shrink because their costs go up, but they can't always pass all of it to customers. That makes earnings look worse. Lower earnings mean lower stock valuations. Second, investors start rotating out of growth stocks and into safer assets like bonds or gold. Why? Because if inflation is running at 4% and the Fed is paying 3.5% on Treasury bonds, real returns are negative. But at least bonds are predictable. Stocks are volatile. And when geopolitical risk is this high, investors want predictability. So you get this feedback loop. Oil shock drives inflation. Inflation prevents rate cuts. No rate cuts mean expensive borrowing. Expensive borrowing slows the economy. Slower economy means lower corporate earnings. Lower earnings means stock prices fall. Stock prices fall means your 401k balance drops. That's the spiral, and it's already starting. Mechanism 3, the defense boom and the portfolio rotation. On Friday, before the strikes, Lockheed Martin stock was up 2.56%, Northrop Grumman up 2.4%, RTX up 1.2%. Why? Because these companies make the missiles, aircraft, and defense systems being used right now. Lockheed manufactures the F-35 stealth fighter that Israel uses. RTX makes Tomahawk cruise missiles. Northrop builds the B-2 stealth bombers. These are companies with contractual revenue locked in. Lockheed's backlog is $179 billion. RTX has a $251 billion backlog. Those contracts just became more valuable because the probability of follow-on orders went way up. When the U.S. is engaged in sustained combat operations, defense budgets expand. And when markets open Monday, institutional investors are going to price that in. But airlines are going to get crushed. They face two problems simultaneously. First, jet fuel costs spike. Second, airspace closures in the Middle East disrupt routes. Emirates, Air Arabia, and other carriers already diverted or canceled flights Saturday. Higher costs plus lower revenue equals collapsing profits. Delta, American, United Airlines, all of them are going to feel this. The same applies to consumer discretionary retailers. When oil prices go up, consumers have less disposable income. Less spending means retailers see weaker sales. This is the portfolio rotation. Money flows out of airlines, out of consumer stocks, into defense, into energy producers like ExxonMobil and Chevron, and into gold. The investors who understand this are already repositioning. The investors who don't are going to wake up Monday to a portfolio that's down 3 to 5%. Now some will say, but the U.S. Strategic Petroleum Reserve can stabilize prices. OPEC Plus just raised production quotas. The market will adapt. But the world consumes roughly 100 million barrels per day. The Strait handles 20 million of that. If the Strait is closed for 1 month, that's 600 million barrels of supply offline. The SPR can't cover that. Even if the U.S. releases oil at maximum rates, it only fills part of the gap. Iran knows that sustained pressure is their leverage. They'll keep the Strait closed as long as the conflict continues. Second, OPEC Plus raising production by 220,000 barrels per day sounds helpful, but compare that to the 20 million barrels per day flowing through Hormuz. It's a rounding error, and even if they could replace the Strait, there's a physical infrastructure problem. You can't redirect tankers instantly. Insurance costs spike. Some insurers are already refusing to underwrite Hormuz traffic. Those costs get passed to consumers, at the pump, at the grocery store. Third, the market narrative around inflation is about to shift violently. For the last 6 months, the consensus was that inflation had peaked. The Fed was positioned to maybe cut rates later this year. That entire narrative just collapsed. Because you can't have an oil shock and falling inflation at the same time. When energy prices spike, they cascade through the entire economy, which means rate cuts are off the table, probably for all of 2026, maybe into 2027. The geopolitical risk premium just got permanently repriced. Investors had gotten comfortable ignoring Middle East tensions. Venezuela in January didn't touch global oil flows. This is different. The Hormuz closure is real, and once that risk premium gets baked into asset prices, it doesn't come out easily. That means oil trades at a structural premium. That means inflation runs hotter. That means the Fed stays tighter. That means growth slows. And that means your portfolio faces a structurally worse environment for returns. So here's where this goes. 2 paths, and the next 30 days will tell you which one we're on. Scenario 1, Controlled escalation. The conflict stays regional. The strait reopens within 2 to 3 weeks after diplomatic pressure. Oil prices spike to $85 but stabilize there. OPEC Plus ramps up production enough to offset some of the gap. The SPR gets tapped moderately. Gas prices go up 40 to 60 cents per gallon and stay there through summer. Inflation ticks up by 1% but doesn't spiral. The Fed holds rates steady through 2026, but signals cuts might come in early 2027. Stock market volatility stays elevated but doesn't crash. The S&P 500 trades in a range, down 5 to 8% from recent highs, but stabilizes. Defense stocks outperform, airlines underperform, but the damage is contained. In this scenario, your 401k takes a hit, maybe down 5 to 7%, but it's temporary. If you're 20 or 30 years from retirement, you ride it out. If you're within 5 years of retirement, you rebalance into safer assets. This is the manageable scenario. It requires diplomatic breakthroughs, restraint from Iran, and competent execution by the Fed. Scenario 2, the oil shock recession. In this scenario, the conflict escalates. Iran keeps the strait closed for 6 to 8 weeks, maybe longer. The U.S. commits more military assets. Regional allies get pulled in. Oil prices spike to $110 to $120 per barrel. Gas at the pump goes up $2 per gallon. Consumer spending collapses because households are allocating 20 to 30% more of their budget to energy and food. Corporate earnings crater in Q2 and Q3 because input costs explode and demand falls. The Fed is trapped. They can't cut rates because inflation is running at 6%, but keeping rates high pushes the economy into recession. Unemployment ticks up. Housing sales freeze because nobody can afford a 6% mortgage when prices are still elevated. Stock market drops 10 to 15%, maybe more if earnings miss badly. Your 401k is down 12 to 18%. If you're close to retirement, that's catastrophic. You're forced to delay retirement or accept a permanently lower standard of living. Defense stocks rally 20 to 30%. Energy stocks rally 15 to 25%. But everything else bleeds. Airlines down 25%. Retailers down 15%. Tech stocks down 12%. Gold hits $6,500 to $7,000 as global investors flee risk assets entirely. In this scenario, the economic damage is structural. It's not a dip. It's a regime change. And recovery takes years, not months. The historical parallel is the 1973 oil embargo that triggered a recession, stagflation, and a decade of underperformance in equities. You could be looking at the same playbook. The difference between scenario 1 and scenario 2 comes down to 3 variables. 1, how long does the Strait of Hormuz stay closed or restricted? 2, does the conflict escalate beyond Iran to include broader regional actors? 3, can the global economy absorb a $20 oil shock without triggering a recession? If any one of those goes wrong, you're in scenario 2. If all 3 go wrong, you're in a multi-year economic crisis. Here's what you need to watch. Signal 1, oil futures, when markets open Sunday at 6 p.m. Eastern. If Brent crude opens above $85, we're trending towards scenario 2. Signal 2, Iranian retaliation in the next 72 hours. If they hit Saudi oil infrastructure or UAE facilities, the conflict is spreading. Signal 3, OPEC plus emergency meeting announcements. If they call an emergency session beyond what they already announced, the cartel thinks the shortage is severe. Finance Deciphered doesn't exist to sell you solutions. I'm showing you the data that institutional investors are already acting on, while retail investors wait for CNBC to explain it 3 days late. I just walked you through the Strait of Hormuz choke point that controls 20% of global oil supply, the inflation spiral that the Federal Reserve can't stop, and the portfolio rotation happening right now before markets even open Monday. These aren't predictions. These are mechanics already in motion. Oil futures are already up 5%. Gold is already at 5,300. Defense stocks are already positioned. The only question is whether you understand what that means for your money before it's too late. Subscribe to the channel, hit notifications. Because when oil futures open Sunday night, when the Fed makes its next statement, when Q2 earnings reports start showing the damage, I'll be here breaking it down in real time. Comment below which scenario you think we're in. Controlled escalation or oil shock recession. All sources are linked in the description. And remember, the war started Saturday, but the economic war on your portfolio started the second oil futures spiked.